Welcome to this episode of the Markets and Leaders podcast, where the conversations are actually about power and actually about moves, how capital actually concentrates, and how decisions get made long before markets ever react. Now, this isn't about assets in isolation or surface level narratives. It's about the structures behind them, the people who influence them, and the forces shaping where money, control, and opportunity really go. And today's conversation sits exactly in that space. Now, most people know our next guest as the gold guy, the silver guy, the commodities guy. But that version of our guest is only the tip of the iceberg at the surface level narrative. Mr. Rick Rule is sitting here with us today for the real conversation in power, land, capital flows, private banking, geopolitics, and who actually controls value when systems start to fracture. This isn't a conversation about charts and tickers. It's about leverage. It's about sovereignty, land ownership, monetary power, and how capital really moves when fear enters the room. Rick has seen every single cycle, every crash, every euphoria phase, and today we're going way past the headlines and into the uncomfortable territory investors think about, but rarely hear spoken out loud. Rick, welcome back to the podcast. It's so great to have you. I think you were one of our first episodes on this podcast, so full circle, here we are again.
Well, congratulations on the success of the podcast. That's a pretty big order that you've left me with. My temptation when I heard it was to leave, but let's try.
You know what? I have big shoes to sit with for sure. When I know that you're coming in the studio, it's like I want to hit those conversations that many are not talking about, because I'm sure that you do a billion of these and it's the same question. So that's why, I want to prepare a little bit more. Now, Rick, you've spent decades in the capital market space, from building Battle Bank to steering Rule Investment Media. And you've been candid this year about diversifying and repositioning portfolios, really navigating that mask risk and digging into markets that most commentators barely touch. So today I'm going to go beyond the typical silver and gold narrative. That's really where I want to go. And we want to talk about drivers that are shaping capital, that are around policy, around geopolitics, land, and really actually the future of money here. So let's start where investor psychology really meets real world. That's where I want to start. You've talked about the dollar's role, central bank behavior, and structural profit are pressure on the fiat, okay? If we unpack that from the surface level here, how much of today's market moves are really geopolitical versus fundamental economic shifts?
Probably the truth is somewhere in the middle. I found that geopolitics, which is to say the big picture, gives people the narrative excuse to do something that they probably wanted to do anyway. If you are inclined to buy gold and Mr. Trump does something particularly stupid, you use that as an excuse to buy gold.
Okay.
My suspicion is that the underlying reason, as an example for the gold moves, is very different. But geopolitics gives you the psychological excuse to express your will.
Right.
I think it's very important, in particular for capital markets professionals, to understand that the news trades are very short-term, very narrative-oriented.
Very quick.
And often, if you're courageous, which I'm not, what you do is you trade against those.
Okay.
I'm not a trader.
Okay.
I'm an investor. For me, my expected duration is 3 years or 7 years or 10 years. But I'm competing, mercifully, with many people whose duration is 4 weeks or 6 weeks or 7 weeks. It's easier to beat those people if you think longer term. And the geopolitics, as I see, are narrative trades as opposed to fundamental trades.
Absolutely. So what would you say is still being missed by most investors then?
Most investors are still living in the past, which is easy to do. The period 1982 to 2022 was probably the most benign economic climate in human history.
Okay. How so?
Like the nursery rhyme, not too hot, not too cold, just
yes.
right. We had a bunch of things happening. My demographic, the baby boomers, were coming into their peak earnings, their peak production, their peak spending period. So we had this wonderful demographic tailwind. Now we're dying. So that's changed, right? I mean, literally, not figuratively. We had a period of declining real and nominal interest rates from 1982 to 2022. So that was a tailwind. We had the good part of globalization, specialization. We brought 600 million Chinese up from rural penury to middle-class existence.
This is true.
We brought women into the workplace. We were inclusive. We had 40 years that were great. I think beginning around 220, but beginning to manifest itself in 2022, things began to change.
How so?
Well, for one thing, we squandered the opportunity we had for 40 years to save. Government spent, consumers consumed,
Yes.
but nobody invested.
Yeah.
And so we went in the United States, as an example, to having on-balance sheet federal debt at 25% of GDP, to having on-balance sheet government debt of 120% of GDP. We wasted a 40-year benign epoch. I mean, it took special skill to be that stupid. And now I would suggest to you the chickens are coming home to roost. As a consequence of the fact that we spent as opposed to saved and invested, real interest rates are rising as opposed to falling. You'll notice that the governments are doing whatever they can to suppress near-term interest rates, but the long-term interest rates are going up anyway. There's a gap between the short-term rates, which the government controls, and the long-term rates, which the market controls. If you are a good investor and you anticipate it, that's not a bad thing. The difficulty in capital markets is that people are still expressing the preferences that they learned in 40 benign years in years that will be both different and more challenging.
Okay, well, that makes a little bit more sense now. What if we go beyond commodities then and we look at land as an asset? Why don't we look there? So real estate and land has historically been a fundamental wealth store. How do you view land, especially strategically located land, now in today's investment framework compared to commodities?
I am not a real estate professional. I've done extraordinarily well in real estate because I had the wind at my back. If you develop real estate with a fixed mortgage, your cost of capital stays the same while your return on capital grows. And if you're patient, and I am nothing but patient, the delta between your cost of capital and your return on capital employed grows every year, which means your wealth grows every year.
Okay.
I began to sell aggressively my developed real estate in 2022 because I could see that the interest rate wasn't falling anymore. It was rising.
Yeah.
And any advantage that I might have enjoyed simply as a consequence of my patience went away. What you surrender in that kind of market to is somebody who's good at real estate, and I'm not. I own farmland and I own timberland, two classes of real estate which I would suggest I know better than most of my competitors. But in terms of things like multifamily or private storage or industrial, I'm the same kind of babe in the woods that a newcomer in this mining investment conference would be to me.
Yeah.
And I prefer to invest in sectors where I'm not a babe in the woods.
You know, that's a really smart, there's so many in that little answer right there, that little one, there was so much insights there that people even my age are looking at going, ooh, I should write that down. I should be taking notes for sure. Well, I'm going to hand over the mic right at this point, and I'm going to just hold some space here for your bank, BattleBank, and really put that beside private capital. Because this is a topic that is definitely one that stands on its own, and it's making some real moves for sure. Now, you have co-founded BattleBank, and through that, Rick, how do you see the role of private capital and alternative banking evolving in an age of institutional constraints and that macro uncertainty?
Well, first of all, private credit should all be about competitive advantage. The topic of private credit or private equity, private capital, will cost you a lot if you employ capital in a sector where you or your manager doesn't understand it.
Okay.
I've looked at opportunities in private credit and private equity in all kinds of sectors. And frankly, when I was a younger man, and I thought I was smarter than I think I am now, I dabbled in industries that I didn't understand well with a predictable outcome.
Okay.
So I confine myself now to industries where I have a lot of experience. Those are two: natural resources and conventional financial services. I know about the insurance business because I've insured natural resource companies. I know about wealth management because I've managed wealth in natural resources. I know about asset management because I've run investment banks in natural resources. And I know about banking. So for me, the private capital allocation that you talk about is all wrapped around intellectual capital. And I have that in banking.
Okay.
To go to the question, I backed my current co-founder, Frank Trotter, who had been my banker, somebody I knew fairly well.
Perfect partnership then.
Yeah, that's right. We knew each other. We knew each other's faults.
That's right.
Well, I backed him to start one of the world's first online banks in 1999. We started something called EverBank.
Wow.
And it was a wonderful experience. Three guys, really, doing something that hadn't been done before. So by definition, we didn't know anything about it. We had some ugly early learning experiences.
Of course.
But we built a really successful bank. We built a bank that had, at the end, by the time we sold it, 275,000 customers who weren't merely happy, they were ecstatic.
Rick, that's
which
amazing.
was wonderful. I mean, to wake up in the morning and get emails from people saying, it is so pleasant to deal with you.
Unheard of now.
It's wonderful. So what did we do different then?
Yeah.
We didn't have branches.
Okay.
A branch costs you between 150 and 175 basis points a year, which if you don't have that expense, you can pass off to your depositors or pass off to your borrowers or pass off to your shareholders. That's a good thing. People say, what about the convenience of a branch? I go into my big box branch now. Wonderful woman runs the branch. Very nice. She always gives me tea and cookies.
Oh, well, that's essential.
You know, I could have tea and cookies at home. The problem is she actually doesn't know very much about banking.
Ooh.
So the utility that I have going into the bank and the utility that the bank has servicing me through that channel is very, very, very low. It is true that unsophisticated customers probably need branches. And to be honest with you, bankers like me don't want to deal with unsophisticated customers.
Mm-hmm.
We believe that there should be banks for dumb people, but we don't believe they should be ours.
Okay, well, fair enough.
What else did we do at EverBank? The first thing is that we knew at that time, and we know now, that there are a whole bunch of deposit products that don't pay people interest, like their checking accounts.
Yeah.
And we told the market, if you're interested in interest, check out Battle Bank. That resonated with a lot of people. And so rather than have 15 or 16 deposit products, 5 or 6 of which hoodwinked you into not receiving interest, we had one high yield deposit. Write checks about it, against it, fine. Do wires, fine. No fees, we pay you interest. One simple product. We're not here to cheat you. We're not here to trick you.
Mm-hmm.
And that really resonated with the market. The second thing that we decided in 2000 was that decade, 2000 to 2010, was going to feature an awful lot of currency turmoil, volatility. And we allowed our customers to bank in 28 currencies.
That's really big.
Most U.S. banks, they give you a choice between the American dollar, and the American dollar. And some people want to go further. And we ended up generating about $8 billion in non-dollar deposits. It was an important business, and the customers didn't like it. The customers loved it.
Oh, I was going to say, why wouldn't they like that?
You know, they were ecstatic. Interestingly, at EverBank, because we developed such great relationships with our customers on the deposit side, they wanted to do other kinds of business with us. They would say, do you guys do mortgages? At the beginning, we'd say, well, yeah, we can do mortgages. And after about 2 months of incoming calls, we specialize in mortgages. We can help you with your mortgage. And we became, at EverBank, I think the 31st largest mortgage originator in the U.S.
Stop. Really?
Without having any customer acquisition expense. We didn't have to advertise because we already had the customers as depositors. Yeah. We just started servicing another part of their wallet. Fast forward, we grow the bank from nothing to $28 billion, something like that. A big U.S. institution, TIAA-CREF, an organization that represents retired teachers, bought us.
I was going to ask, what happened?
They bought us,
okay.
And that was fine. They paid us a good price, sort of a 30-bagger for the early investors, which, 14 years to be an overnight success, that kind of thing. Yeah. And what happened was that the products that were of interest to their base, retired teachers, were very different than the products that were of interest to our customers. And over time, they migrated our bank to service their customers, and they lost our customers.
Why do you think they were so interested in your bank at that time?
They had spent tens of millions of dollars to build an online banking platform, and they failed.
Why would they think it would be any different then? Because yours was established?
Their technology failed.
Oh, okay.
What they thought, and I thought it was going to work at the time.
Yeah.
I thought we have this wonderful platform. We have 275,000 customers. We're solidly profitable. We have all the people in place. They have 1.5 million members.
Mhm.
They can introduce their members to our platform, and they'll build a $300 billion bank. What broke down was their institutional bias was towards fairly low-end investment products to service retired teachers. And the customers that we had, which had 5 times as high balances, felt that the product base that they were being introduced to wasn't of use to them.
Okay.
They moved towards their customer. That was their institutional bias.
Right.
And away from our base.
So have some of those customers that you had back then, have they now signed it with you or come on to BattleBank now?
Surprise, surprise. When we opened EverBank, our customer backlog, the people who'd indicated that they wanted to do business with us,
Right.
was 0. We built the bank from 0. Before we opened BattleBank, 20,000 customers had come to the website,
Wild.
told us they wanted to do business with us, and told us what kind of business they wanted to do. They looked at our product menu and said, we want this, and we want this. When you open, let us know.
They basically
Which is
built your
wild.
business model for you.
Now, in fairness, as you know, I occasionally do interviews like this.
Occasionally.
And our customer acquisition cost at BattleBank has been 0, except for the wear and tear in my carcass.
Right. This is true.
Because I come online and I wear BattleBank
Yes.
logo. But again, to be successful, in order to attract 20,000 people, you have to offer them something that they don't have. You have to solve a problem for them. What is that? Well, still, there's $3 trillion on deposit in the U.S. that doesn't get paid interest. This is just flat stupid. People are worried about all the problems in the world, and they forget that their bank isn't paying them interest, right? Concern begins at home. Control something you can control for.
Totally.
So we're going to pay people interest. I mean, this is a marvel of modern banking.
Yes.
Pay people interest. Still, because EverBank has attenuated the program, Americans can't save in currencies outside the U.S. dollar. Canadians can't save in currencies outside the U.S. dollar.
Yeah.
For Americans or Canadians, if you back at BattleBank, you'll be able to save initially in 20 currencies.
I was just going to ask you, is your bank only in the States, or, Canadians, if we could use that as our...
We can service both Americans and Canadians now, other countries to follow.
Okay.
But rather than go through the regulatory morass of every country before we opened, we're solving for our 2 biggest markets, the United States and Canada, first. Yes, other countries later. First us. Let's talk about some other products. This is for Americans now. In the United States, we have a retirement product called an IRA, similar to your RRSP. In most banks, your IRA is really a receptacle for their products, their mutual funds, their ETFs, their annuities.
True. Yeah.
At our bank, your IRA is your IRA. You want to own a duplex that you operate? You want to own an Airbnb? You want to own a Subway franchise that you operate? You want to buy private equity? You want to buy gold? You want to buy crypto? No problem. Your IRA is your IRA. Any legal activity. I mean, you can't buy fentanyl and sell it on the street. Yeah, I know. You were thinking of that, weren't you? You can't do that.
Right up my alley.
The third difference is that none of our competitors in the U.S. or Canada on the lending side seem to believe that gold, silver, platinum, or palladium are good collateral.
Oh,
And
okay.
I think they're wonderful collateral.
Right.
So if you have somebody like me who saved in gold since 2000, has a lot of gold, and might have a credit need, doesn't want to sell their gold. They don't want to pay the capital gains tax, but they need access to working capital, say to buy a distressed piece of real estate or take advantage of a temporary opportunity. At BattleBank, if you lodge your gold or silver with us, we will establish a credit line. You don't need to borrow the money. You have it available when a need comes.
Through your broker? How does that work?
No. Let's say that you, as an example, have a pile of gold somewhere.
Okay.
And it turns out you have a need.
Okay.
Let's say that there's a duplex or a triplex that you want to buy. You need a down payment. You don't want to sell your metal.
I don't. No.
So we will use that gold or silver as collateral to advance the money.
Okay.
You put down the down payment. You
Got it.
mortgage it conventionally. 4 or 5 years from now, you've worked your magic on the property. You finance out. You use that to pay down the credit line. You have your gold or silver unencumbered, right?
Oh, I see. Okay, I get it.
You can do this in the United States at JP Morgan. You can do it at Canada at RBC for a $10 million minimum. That's inaccessible to many people.
Especially in Vancouver.
At BattleBank, you can do it for $100,000, and we suspect when the business gets big enough, ultimately, we'll be able to do it for $10,000.
That is incredible.
That's very, very, very different.
Mm.
If I lent you money to buy a duplex, and heaven forbid you couldn't pay me back, it would take me 6 or 7 months to foreclose the duplex. I'd probably have to fix it up. I'd have to list it.
Yeah.
If you borrowed money from me against your gold, and heaven forbid forgot to pay me, I could sell you out in 10 seconds, 24/7, give you the balance of what you owe and keep the rest. It's actually much better collateral than what the other banks are lending against. Mercifully for me, that business is too small, about a $35 billion business.
Oh, okay.
For them to care about.
Okay.
For me, it's a banquet. For them, it's a crumb.
Well, it's innovative as well, right?
And it goes to the market I talk to.
Now, could you do that with, say, a crypto holding?
No.
Okay.
Someday, maybe.
Okay.
A bank and organization, if you say to U.S. regulators, if you mention the word crypto, you're on the never, never plan.
Okay. Got it.
And frankly,
fast-tracked.
I know a lot about gold as collateral.
Okay.
I don't know much about crypto. A good banker is a banker who lends against security that he or she understands. If you're talking about a 73-year-old pawnbroker named Rick Rule, he doesn't know much about Bitcoin.
Right. Yes.
He knows a lot about gold.
This is true. Well, let's talk about the future of money then from there, because you've hinted at tokenization of gold and new monetary forms. So this is sort of what we're touching on here. Do you think real assets could become functional money again in this decade?
In this decade, I do. The technology exists today.
Okay.
There are regulatory constraints.
Okay. Tell me more about that.
And those will be challenging. Well, as an example, when we formed EverBank, from preliminary application to charter took 19 months. Mm-hmm. At BattleBank, that same process took 5 years before we bought a bank. Regulations are just slower. Mm-hmm. There is no technical reason now why there couldn't be a really, truly functional gold coin on the internet. You could hold the gold in some depository, as an example, like the Royal Canadian Mint, like right. Sprott does. Yeah. And a token could be a delivery receipt. Let's say that you went to Starbucks. Right. You could pay for your Starbucks with a fraction of a gram of gold, that's a delivery receipt. Starbucks aggregates those. They either sell them, or if they want, with enough of them, they take them to the Royal Canadian Mint, they surrender the coins, and they get the gold.
Right.
The technology exists to do this. The regulation at present doesn't allow it.
Okay, so that infrastructure still is on the...
I think that the World Gold Council and the London bullion market will introduce a tokenized receipt program in 2026 that will be acceptable in certain countries like Great Britain. Okay. When it's accepted in Great Britain, the game's over. You don't have to redeem it in Canada or the United States. If there's one political jurisdiction that allows redemption, the game's over. It's money. There's no reason after that why other commodities couldn't be tokenized, provided that the custodian of the asset, because a token would have to be a delivery receipt. Yeah. The repository of the asset would have to be really, truly trusted.
Fair enough.
And the backing would have to be consistent. I don't think, as an example, you could do it with diamonds because they vary by grade, by clarity, all those kinds of things. You need something like LBMA good delivery copper or gold or silver, assets that varied in quality and value where they weren't standardized wouldn't work for delivery receipts.
Okay.
But other things, LME grade metals, as an example, certainly would. I think probably that you will be able to tokenize anything that you can make into an ETF
This is true. And it's really hitting that younger crowd as well that have a higher risk tolerance. They all started. I was just talking about this morning with Bundeep Singh from Ranger, or Bundeep Singh, he's from Finekia. And we were talking about, how the younger generation, they are a lot more risk takers because it all started with, what was it, EFTs, where they're buying the digital asset. They don't actually own it. It's not a physical asset. So they're willing to take those risks on more of these, forward-thinking.
And it can go beyond risk to practicality.
Yeah.
Let's say that you believe in real estate. Let's say that you own real estate ETFs, as an example. There's no reason why that ETF couldn't be tokenized, or why a package of mortgages couldn't be tokenized. There's no reason why you shouldn't be able to buy a cup of coffee with a fraction of your real estate investment. You shouldn't have to translate that investment into cash and then buy coffee with the cash.
Right.
You ought to be able to spend a token that represents that real estate. You follow what I'm trying to say?
I absolutely am.
There's no reason why an asset class should be disintermediated for cash. The asset itself ought to be cash. That's coming.
Okay, that's what I want to do. Now I'm going to shift the topic over here to something that's a little bit more gray, we'll say. So we're going to shift to U.S. policy and debt dynamics. Here it comes. Your favorite topic.
Sadly, I'm good at that.
So you've described the U.S. fiscal position as a profound arithmetic problem with enormous on and off balance sheet obligations and a political system that sidesteps real constraint mechanisms like a meaningful debt ceiling. So given that backdrop, how do you see the U.S. policy evolving in the next cycle, particularly in terms of monetary response, entitlement reform, and the political appetite of structural change?
I can answer in a word.
Okay, one word.
Poorly.
Now unpack it a little
bit.
The
math is really profoundly bad. How long do I have for this answer?
You go for it, and then we'll just turn the music on like award shows.
Shut me off when you need to.
Everybody grab your coffee now.
Yeah, I have a talk I do. Grab bourbon. It's going to require it.
Bourbon.
Coffee.
Do bourbon. In Canada, you can't get bourbon anymore, but
rye will work.
Right.
So let's look at the arithmetic from the very top. The Internal Revenue Service estimates that the aggregate private net worth of American citizens is $167 trillion. So at home, write down 1.67 tree because it's too many zeros.
Right.
That's what we're worth, okay? Then let's look at the other side of the ledger and understand that this is just the federal government, not state and local, not corporate, not individual debt. The on-balance sheet liabilities of the U.S. government are about to go through $39 trillion. And they grow by between $2 and $3 trillion a year. In other words, we're not pretending to pay this debt down. We're growing it by $2 to $3 trillion a year. That's really pretty ugly.
It really is.
But it gets much worse. Not merely worse. It gets much worse. The off-balance sheet liabilities of the U.S. government, camera point to Rick, that's old people. Medicare, Medicaid, Social Security, military pensions, federal government pensions. That number, according to the Congressional Budget Office, not some fat, cranky old libertarian,
Rick,
that liability is $120 trillion. And that number grows between $2 and $3 trillion a year. So now let's do the arithmetic again. We own $167 million, and we owe $159 trillion. The delta between what we own and what we owe is $8 trillion.
Yeah.
And what we owe grows between $4 and $6 trillion a year.
How are they growing what you own then?
Well, growing what you own has to do with the delta between what you earn.
So you got to bring
what you save.
Right. Yeah.
At the federal level, of course, that's between $4 and $8 trillion a year negative.
Okay.
Now, the big thinkers in the United States, Donald Trump, Robert Reich, AOC, these people say, well, this is easy, tax the billionaires, no problem.
Sure.
Here's the problem with that math. America's billionaires, it turns out, have an aggregate net worth of $7 trillion. So if you didn't increase their taxes, if merely you stole all their money, you solved the problem for 18 months.
That's it.
And the debt's still intact. This isn't me being a Democrat or a Republican. By the way, I'm neither.
It's facts. It's just
this
pure
is
facts.
just a guy who in grade 3 learned to add, subtract, multiply, and divide. 167 minus 39 minus 120. Take the delta, that's 8, and subtract from it between 4 and 8 a year. That's the arithmetic.
Simple.
I'll leave the people at home
Mm-hmm.
to have the values discussion.
Mm-hmm.
Now, how do we get out of this?
Yes. How do you get out of it?
Well, past maybe is prologue.
Okay.
I came of age in the decade of the 1970s. We had fought the war in Vietnam in the U.S., which we lost. We fought the war on poverty, which we lost.
Which we all lost.
We had too much debt. We
Mhm.
couldn't raise taxes. Same situation. We did something fairly clever.
Okay.
Rather than do what the Argentines did, being honest about it and defaulting, we did a time delay default. If we were honest about this, we would say to the bondholders, yeah, we borrowed fair and square, but there's no money.
You can't pay back.
So we're going to stiff you, strong letter to follow. And we'd say to the old folks like me, you guys voted yourself all kinds of cool benefits, but you forgot to pay for them. So you're going to starve in the cold. This will get us a lot of hate, by the way. But that's not what we do. In the decade of the 70s, according to the Office of Management and Budget, now known as the Congressional Budget Office,
Right.
the purchasing power of the U.S. dollar declined by 75% in 10 years, meaning that it took us $4,000 to buy $1,000 worth of goods and services by
Seems
the end of
good.
the decade.
Good deal.
So what we did is we honored the nominal value of our obligations. Well, we inflated away the net present value of our obligations. We didn't index taxes or benefits really to inflation. We inflated away the net present value of the obligations. And then we did something that took real courage. I don't think we'll do it this time. But what we did is we allowed for a quadrupling of the interest rate.
Okay. What does that mean now? Tell me this.
Well, in the end of the decade of the 80s, end of the decade of the 70s, pardon me, Paul Volcker came in and he took U.S. long-term rates from 5% to 18%.
Okay.
That was very difficult on the economy, but it broke inflationary expectation.
Okay.
Here's why that's important. Today, if I buy the U.S. 10-year Treasury, they pay me 4.2, something like that. They pay me 4.2 in a currency that I believe is losing purchasing power at 8% compounded. You'll note I don't believe in the CPI.
Right.
I call that the CP lie. We could have a different discussion about that. But if you looked at the basket of goods and services that you bought in 2020 and today, the idea that your purchasing power is declining by 2% a year is stupid. Look at rent, look at health insurance, look at tax. This is insane. If you calculate the basket of goods and services that I buy, and I'm a rich old crank. I don't buy much.
Okay.
The basket of goods and services I buy is experiencing price escalations of between 8 and 10% a year. So here's where the rub is. I save at 4 in a currency that's declining by 8. I'm not making 4% a year. I'm losing 8% a year.
Yeah.
That's why I buy gold. Think about the arithmetic of the U.S. 10-year Treasury. You give the U.S. government $100,000. They shave 4% a year off your purchasing power. You give them 100, they give you back 50 after 10 years. That's a good deal, right?
No.
What Volcker did is he set the interest rate at a place where there was a real yield on savings. The inflation rate was 11 or 12, and he was paying 18.
Okay.
That broke gold, broke inflation, broke the inflationary mentality, broke millions of Americans. That's what it takes. It's not a pretty circumstance.
It really isn't.
And one of the things that I want to leave your listeners with is when you hear this, the correct response is not to crawl into the corner, get in fetal position and whimper. It's to understand where we're going and understand that in the future, the responsibility for you and your family is with you.
Yeah.
The government's not going to do it. Society's not going to do it. A lot of us got through the decade of the 70s just fine. Those who weren't prepared didn't. But it isn't incumbent on you to be a victim.
That's true.
In fact, it's incumbent on you to take control of your financial future so that you aren't a victim. It's probably incumbent on you to do well enough materially that you can take care of those family and friends who are either incapable or unwilling to take care of themselves, because you're not going to be able to shunt them off on the state 10 years from now.
Now, I want to pull back and really simplify all of that. What does it all actually mean for investors who are trying to position for the risks most people still aren't pricing in then?
Just first of all, don't hold too much stock in what worked in the period 1982 to 2022.
Right.
Don't believe that assets go up simply because more money gets added to the system or more gets printed. Don't believe for a moment that your savings, unless they're pretty big, are sufficient to get you through the next 10 years. Think about the fact that what costs you $1,000 today will cost you $4,000
Yes.
10 years from now. And think about how you position yourself to take care of that. If you believe that you're in Canada, the Canada pension plan is going to sustain you at the living standard that you enjoy today, understand it's not going to 10 years from now.
Yeah.
And begin to prepare yourself today.
All right. Well, let's keep going with this then. We're going to bring in the central banks. As we've been hearing, central banks, they keep talking about inflation rates, inflation targets. Yet some of your recent commentary actually suggests a very different narrative. So how do you differentiate what central banks say versus what markets are actually pricing?
I'm 73 years of age. I have never in my life known a successful politician that was honest.
Okay.
So I pay very little attention to what central banks say.
Okay.
Because they're political organizations. If I was running, let's see, for Premier of the province of British Columbia, and I said, what I promise you in the future is self-reliance and penury. In other words, I told the truth. What's the probability I get elected? Correct. So understand, first of all, that what the central banks say should be confined to the same part of the paper that has the funnies.
Oh, the comics.
Yeah. I mean, the CPI, that's how they that's how they report inflation to you.
Right.
The CPI.
Yeah.
Well, first of all, when it's inconvenient, the CPI doesn't include food or fuel. I don't know how much of me this camera's covering, but any index that doesn't include lunch is of no interest to me at all. I don't care. And I drive on occasion. So how is that a relative number? The second thing is that the CPI doesn't include tax. It doesn't include government.
It doesn't, yeah.
Now, if I didn't have to pay the tax, I wouldn't bitch so much about the index. But that's not on offer, right? And the third thing is it's hedonistically adjusted. I'm not sure I know what that means. But apparently, what is of interest to the people who compile the index is what they think something is worth rather than what I paid. Okay. If my computer today cost me $2,000, but it's more powerful than a computer 4 years ago that cost $2,000, they don't pay attention to what I paid. Rather, they pay attention to the value that they think I received.
Yes.
Which is, in a long way of saying, the CPI is the CP lie.
That's true.
But they've managed to create a factoid. They have managed to cause Americans and Canadians to believe that the CPI is the rate of the deterioration of the purchasing power of our respective currencies. And it's not. So the first thing to understand is that your purchasing power is being degraded by 8% a year or 10% a year compounded, not 2.5%. They talk about the fact that wages have fallen. That's not true. The currency has fallen.
Yeah.
The minimum wage that prevailed in 1970 was $1.25 an hour. That would have bought you almost an ounce of silver.
Not now.
So if the wages had been paid in real money, which is to say silver, today you'd be getting $111 an hour.
Yep.
it isn't that wages have deteriorated so much. It's that costs have been priced in felonious currencies. It's important that people understand the difference between what they get paid in and value.
That's very true.
Most people don't do that.
I really hope everybody out there is taking notes, has your bourbon in hand and taking notes, actually, because this is pretty informative. Now, Rick, last time you were here, we talked about diversification of portfolios. And we talked about things that you mentioned were, put some of your investments into land, actually. So let's talk about land and the resource national strategy. In many of your recent conversations, you've made a point that globally, we have underinvested in the productive capacity that underpins economic value or life. So whether that's copper or oil or the basic materials that society depends on. Now, you've also highlighted the real assets, the stuff on the planet, not the financial instruments. They're the ones actually really telling the story, because the story of, we'll say, structural financial instruments or the structural value. Because over time, what's happening is policy can't be created by much more alone, is what I'm saying. And that's really ultimately what nations start fighting about when scarcity hits. So while much of the dialogue in capital markets is, yes, around currency and it is around markets, the geopolitical reality is increasingly shaped around access to food, around land, critical minerals that power everything from agriculture to tech supply chains and all those things. Those are the forces that really determine not just your return, but they also are included in that national security itself. So from a geopolitical standpoint, Rick, I mean, how should countries think about land use strategy in agriculture, in minerals, access to water as part of national wealth as well as security, both of them?
I think the citizens of the countries should take the decisions out of the hand of their leaders.
Okay.
First of all.
Yeah.
I think
we see it across the board right now in the world. So
I think that decisions about your future should be yours. If I were you, I know for sure I don't want Orange Julius making my decisions. And if I were you, I wouldn't want Carney making my decisions. So in terms of food security, what do you like to eat? What does your family like to eat? How are you going to get access to a diet that appeals to you?
Right.
How are you going to get access to how you'd like to live? Resist your government's attempts to impose their will on you. I mean, I understand the nature of the question.
Yeah.
What I wish is that as citizens, we began to reassert control over our futures and take them away from the politicians. It's odd that you mentioned politics. I'm in the resource business. 5 or 6 years ago in the U.S., I expected the government's response to my preference for hard assets to result in my picture being posted on the post office wall under wanted.
Wanted.
Now these same morons want to subsidize me. You know, as opposed to being a felon, all of a sudden they need to subsidize me. I've got to say, I felt cleaner when I was regarded as a felon.
Yeah.
But it talks about, if you will, the fallacy of policy. I think there will be important discussions to be had around geopolitics, and I'm certain that the political class will make the wrong decisions. If you look back at history, they have a track record unblemished by success. I remember the first Iraq invasion as an example. The then CEO of Exxon, a guy who knew a little bit about oil,
just a little bit,
said to our then president Bush, that if the war was about oil, it's cheaper to buy it than to steal it. Now, that was very, very, very smart. It's cheaper to buy it than to steal it. Markets work.
Right.
And I think that's an important consideration now. My own belief, as an example, is that in a dispute between the United States and China, as an example, the best thing that the leadership of both countries could do is shut up, go sit down, and talk to them.
Yeah.
They have a wonderful investment in productive capacity over 30 years. They have made a whole bunch of products around the world much, much, much cheaper. And we vilify them for that.
Yeah.
Now, this is truly insane. The price of all kinds of consumer goods have come down. And as a consequence of that, they're villains? I mean, give your head a shake. Is there something wrong with cheap computers? This is truly insane. We need to be more, not less, interdependent.
Yeah, we're also in a system right now where luxury is looked at as status quo now. So why would I buy a cheap computer? That's going to make me look a certain way. I need to have the best of the best so that I feel like I fit in now.
Right.
Yeah.
Different topic.
Yeah.
We could talk about status too, but that's obviously if people can look at me, they can see, they can tell I don't care much about status. Can't even spell Gucci.
It's got 4 C's somewhere in it. I love that answer. I love that you kind of simplified it a little bit more too. And I want to now push away from that and talk about behavioral investing. Now, you've been in the markets a very long time, and the more that I learn, the more that it becomes so much more clear. I mean, I have a background too in psychology, and I've been able to use that to learn a lot more deeper about the markets and about investing. And, there is a massive emotional component to any investor. Whether it's good, it's bad, it doesn't matter. And the biggest one has always been fear that I see. Fear of missing out, fear of holding on too long, fear of the unknown. Now, you said investors are either contrarians or victims. So what is the most important behavioral signal you're watching right now that the average investor is missing?
The fear stems from a lack of knowledge.
Mm-hmm.
That's really what it stems for.
That's true.
Most investors haven't taken ownership of their investments. They don't know enough about what they invest in to be confident.
Right.
So they're fearful.
Right.
The first thing is simply to take control of what it is you do with your own money. I don't want to be really sexist, but I'm going to be.
Okay.
As a consumer, I can tell by looking at you, beautiful blouse, about consuming clothes.
Right.
Think about investing the same way you consume clothes. You have a very good idea the outcome that you desire when you go to buy that blouse. You've done due diligence on blouses, and you don't shop at the most expensive place.
Nope.
You try to get as much utility as you can, given your specific needs when you're shopping for a blouse. If you bought a stock the same way you buy that blouse, when you headed out of your house this morning to come to this interview, you were confident in how you looked. You were confident about that blouse because you were an informed consumer. You took ownership of your future with that blouse.
Right.
That's the way you have to be with your stocks.
So smart.
You have to walk out in the morning and say, you know what? I nailed this. I got this. On the street, somebody says, I prefer black. So you go buy black.
Go
I
for
like
it.
this.
Yeah.
Then the fear goes away.
Okay.
Then the fear goes away. Now listen, I don't get every investment right. Far from it.
What?
Far from it. But I don't expect to get every investment right.
Okay.
I expect to end a 1-year period, a 5-year period, a 10-year period ahead of where I was at the beginning. And I intend to have enough money off the table that even if I have a very bad year, it doesn't change what I have for breakfast. Now, I could probably use some help with my wardrobe. I'm a little the wrong way. But really, when you mention fear, the immediate answer to me is that knowledge conquers fear every time.
Yeah.
Knowledge and discipline conquer fear.
And we put a lot of weight too, like, on our broker or, things that we hear in the headlines. And that's a big thing. Like, don't put so much on your broker as well, because they have their own systems and their own plan in place for whatever they're doing with your money as well. So that's great insight. Now, I know all of that is because we also live in a world with it's very high with uncertainty and polarized narratives. I definitely know that. How do you balance risk and conviction when newcomers are so focused, Rick, on the next big thing?
That's their problem.
Okay.
I mean, it really, truly is their problem.
Okay.
I've dealt with investors for 50 years. I've tried to calm people down. I've tried to tell people, do what you know how to do. I've tried to tell people that an asset class doesn't make sense unless it makes sense to you.
Right.
I ask people, as an example, who are in the conference next door, who are buying small, risky mining stocks, they're flooding in right now because the price is up. What I tell people is that an asset that sells for twice as much, where nothing has changed in terms of underlying fundamentals, is only half as attractive. Think about that.
Yeah.
Everything.
Repeat that for us.
An asset where the price has doubled, where the underlying fundamentals haven't changed, is half as attractive.
Half as attractive.
People require price information to validate a narrative. The narrative doesn't change. The price goes up. Now the narrative is real, but some of the benefit of understanding the narrative has already gone in the market. Everything that's true today about the silver price at $111 was true 5 years ago at $20. The only thing that's different is that $80-something or $90 worth of the benefit is gone. That's all that's changed.
Okay.
Nobody wanted to buy the stuff at 20, and everybody wants to buy it at 110 or 111.
Of course.
There's nothing I can do about it other than buy it at 20 and sell it back to them at some higher number.
Yeah. Where do you see, so we'll dip in a little bit to the silver one. Do you see that continual excel, or do you think that it's going to plateau and correct in 2026?
In 2026, I have no idea.
Yeah.
I believe, in a very broad sense, because I think in longer term, I believe, well, I said earlier in this interview that I thought the U.S. dollar would lose 75% of its purchasing power over 10 years. If that's true, and I think it is, I believe that the nominal price of gold will reflect that decline in purchasing power. That means over 10 years, I would be surprised if the gold price, the nominal price of gold, the U.S. dollar price of gold, didn't double, perhaps triple, maybe quadruple.
Really?
I believe that they're inverse assets.
Right.
And I believe that once you reach a point in a precious metals bull market, which we're at, that generalist investors come into the space, that silver outpaces gold. So I expect the silver price to do well over 10 years.
Over 10 years.
I will tell you this, though. I've been through a lot of bull markets. And you don't have bull markets without 35% retracements.
Okay.
You don't have them. So could the gold price go, by the way, in the big bull market, the 1970s bull market, in 1975, there was a 50% retracement. Could the silver price go from 111 to 50? Faster than you know.
Absolutely.
Will it? I don't know.
Yeah.
I don't know. In the near term, I know this. You see a parabolic chart. You Canadians call them hockey stick charts.
Yes.
Those of you who know a hockey stick know that the backside is just as steep as the front side, but it's a lot less fun if you're long. So if you are thinking in 10-year time frames, think in 10-year time frames.
Okay.
Too many speculators have a 5-year strategy and they have 6-week tactics.
Oh.
And that doesn't work.
That's right. That's true. Okay. As you know, here on Markets and Leaders, in every episode, we always end things off with a fun game.
Great.
So this one is not like our popular rapid fire game. This one is a little bit different. So the name of the game is called Show Me the Money. Okay, let me explain the game. I'm going to give you 100 units of capital.
Yep.
You can't hold cash. You can't hedge it.
I can't hold cash.
You can't hold cash. You can't hedge, and you can't split the rules. Rickroll, you can't split the rules. You have to allocate all 100 across 5 areas, okay? Here's the 5 areas. Land and water systems, energy and power infrastructure, monetary assets, food and agriculture systems, technology, and automation. How do you show me the money, Rick?
I throw out technology and automation because I don't understand them.
Okay, so you're going to do 100 credits. All there? Or you throw it out? You throw it out.
I throw those out.
Throw it out.
No money goes there, not because they're bad sectors, but because I'm ignorant.
Okay.
What are monetary assets, just out of curiosity? I don't know what that is.
Let's say currency. We can do currency. Yeah.
Okay.
We can do...
Well, that becomes cash.
Yeah. Can't do cash. Okay, monetary assets. What would you think of as a monetary asset?
I don't know. If you're talking about the S&P 500, then
Let's do that.
That I could begin to talk to that.
Yeah.
I'd probably put, at current levels, 20%. If I could define monetary assets as an equal dollar-weighted S&P 500, which is to say not concentrated in NVIDIA and technology stocks, I don't understand.
Yeah.
But the broad market,
Okay.
I'd put 20% of my equity in the broad market.
Okay.
Then what did you say for timberland and farmland?
For food and agriculture or land and water systems? There's land and water systems, energy and power, monetary assets, food and agriculture.
Energy and power right now, I'd be easily 40%.
40%.
I mean, my own allocations right now are 50% equity.
Okay.
50% energy. So
Okay.
that was easy.
So 40 in energy and power, 20 in monetary assets. You got 40 left.
Okay. You don't have gold in there.
No.
Okay.
Food and agriculture, land and water.
I think of those as one asset class, so that's difficult for me. I mean, I own agricultural land, and the agricultural land I own, I've bought for 30 or 40 years with a focus on water rights. In other words, to me, water is an input for agriculture. And early on in California, when I was buying agricultural land, I got the water rights for free.
Really?
Which was a good asset for me.
Absolutely. So would you do split? You 30 for land and water and 30 for agriculture?
Probably. Well, I don't know. I don't know how you fit timberland in there. I don't know how you do that.
Well, I think that one would. I mean, if we're splitting it right out, food and agriculture systems, there's systems.
That's probably 20%. I have nothing in systems.
Right.
It's like I don't own Kellogg or any food companies. I own farmland.
Fair enough. Okay, so then your 40% would be land and water. Okay. Good deal.
Understand that I'm a 10-year investor. Many of your listeners probably have trauma holding an investment over a long weekend. I'm very different from them.
Long-term investor, right? Not short-term listener. Okay, well, that's it. That's how you show me the money. You did it. It's a bit difficult when you have to start sort of thinking about it, too.
Yeah, the categories are different than the way I think, so I had to adjust what I think.
Absolutely, yes. Absolutely. So, Rick, I cannot thank you enough for being back on the show.
Thank you.
Can't wait to have you back, and we can just dive into some more things, too. So I watch your interviews a lot, and we're going to keep diving into all those together. Thanks a lot.
Thank you for the opportunity.
Absolutely. This is exactly why markets and leaders exist, not to talk about assets in isolation, not to repeat market narratives, but to really unpack power and systems and the real architecture behind capital. Now, Rick Rule doesn't speak in trends. He definitely speaks in structures. And those structures shape how money moves, where risks hide, and where opportunity actually lives. So if you want to go deeper into Rick's work, his thinking, and his investment ecosystem, you can find him through BattleBank and his platforms where real asset strategy meets real-world capital discipline. His websites are battlebank.com and ruleinvestmentmedia.com. Now, here comes the disclaimer. Remember, these are the opinions of our own with possible vested interest in any or all of the companies we speak about. Always be sure to speak with a licensed financial advisor and know your own risk tolerances. This is not to be used as financial advice. For a copy of our complete disclaimer, head over to apaton.com. This has been the latest episode of Markets and Leaders Podcast, Real Conversations, Real Power, Real Capital. I'm Lyndsay Malchuk with Apaton Media, and this is where influence, money, and systems collide. We'll see you next time.